Today, we will talk about due diligence, a systematic way to analyze and minimize risk from a business or investment decision. Due diligence is an investigation, audit, or review performed to confirm facts or details of a matter under consideration. In the financial world, due diligence requires an examination of financial records before entering into a proposed transaction with another party. Due diligence became common practice in the United States with the passage of the Securities Act of 1933, making securities dealers and brokers responsible for fully disclosing material information about the instruments they were selling. If they exercised due diligence when investigating the companies whose equities they were selling and fully disclosed the results, they could not be held liable for information that was not discovered during the investigation. Due diligence can be categorized as hard or soft based on the approach used. Individual investors can conduct due diligence on stocks using readily available public information, such as capitalization, revenue, profit trends, competitors, valuation multiples, management and share ownership, balance sheet, stock price history, stock dilution possibilities, expectations, and long and short-term risks. When considering investing in a startup, some of the steps for stocks are appropriate while others just aren't possible because the company doesn't have the track record. In the mergers and acquisitions world, due diligence involves financial analysis, analysis of future growth, structuring of the acquisition, current practices and policies, and shareholder value analysis. Hard due diligence focuses on earnings, aging of receivables and payables, cash flow, capital expenditures, and intellectual property and physical capital in sectors such as technology or manufacturing. Soft due diligence focuses on how well a targeted workforce will mesh with the acquiring corporation's culture, compensation and incentive programs, and target company's customers and clients. Due diligence is a process or effort to collect and analyze information before making a decision. It is often used by investors to assess risk and involves examining a company's numbers, comparing the numbers over time, and benchmarking them against competitors to assess an investment's potential in terms of growth. Due diligence is primarily a way to reduce exposure to risk and ensures that a party is aware of all the details of a transaction before they agree to it. Examples of due diligence can be found in many areas of our daily lives, such as property inspections before completing a purchase, an acquiring company examining a target firm before completing a merger, and an employer performing a background check on a potential recruit. Due diligence is a systematic way to analyze and minimize risk from a business or investment decision. It is used in many contexts to ensure informed decision-making and is crucial for investors, broker-dealers, and companies considering acquisitions. Here are 5 key takeaways. 1. Due diligence is a systematic way to analyze and mitigate risk from a business or investment decision. 2. An individual investor can conduct due diligence on any stock using readily available public information. 3. The same due diligence strategy will work on many other types of investments. 4. Due diligence involves examining a company's numbers, comparing the numbers over time, and benchmarking them against competitors. 5. Due diligence is applied in many other contexts, for example, conducting a background check on a potential employee or reading product reviews. Hope this would help. Thanks for watching.